Good morning students. Yesterday I discussed with you first financial decision, that is investment decision. Now I will discuss with you second financial decision, that is financing decision. Financing decision means deciding how much amount of finance should be raised from different long-term sources of finance. Students, there are two long-term sources of finance, debt and equity. So every firm, whenever is going to arrange long-term finance, they have to decide how much finance they should arrange from debt and how much they should arrange from equity. What is this debt? Debt is actually the amount of loan which a firm takes from somewhere, from any bank or from any financial institutions, or you can say debentures. Debenture is a type of security which is issued by the companies to arrange money from the public. So debt includes debentures, long-term loans and public deposits. And what is this equity? Equity means share capital, which is arranged by business organization by issue of the shares. Anyone who is buying shares of a company, that person has to pay some price of the share per share. Like a price of one share is 100 rupees, then every shareholder who is buying the shares, he has to pay 100 rupees per share. So equity includes share capital as well as reserves and surpluses. So students, till now I told you long term finance can be of two type, debt and equity. Debt includes debentures, long term loans and public deposits. Equity includes share capital, reserves and surplus. So now if anybody is investing his or her money in any company by the way of loan, debenture or shares, such person will expect some return also from the side of company. Like anyone who is giving loan to the company, that person will expect some interest from the company. Anyone who is buying debentures of the company, that person will also expect some interest from the company. So the amount of interest paid by the company to such persons who have invested their money in the company, that interest amount is called as cost of that security. Like on debentures, interest is paid by the company. So what is the cost of debenture? Interest. On long term loan, interest is paid by the company. So what is the cost of loan? Interest. On shares, dividend is paid by the company. So what is the cost of shares? Dividend. So in this way, on every source of finance, there is some cost which is borne by the company, either in the form of interest or in the form of dividend. So students, I discussed with you two long-term sources of finance, debt and equity. I told you what is included in the debt, what is included in the equity. Now I am going to make a difference between debt and equity. Two major points for making difference between debt and equity are cost and risk. Students, from the point of view of cost, debt is the cheapest source of finance, because on the debt means here I am talking about debentures and long term loans. On debentures and long term loans, company have to pay only a fixed amount of interest. So I will say here cost of debt is very low. But if I am talking about equity, means shares, their cost is very high, because on shares, whatever profit is earned by the company, the whole profit is distributed among shareholders in the form of dividend. So cost of equity is very high. So I think this point is clear to you all. Cost of debt is low and cost of equity is high. Now second basis of difference is risk. So students, in case of debt, debt is the most risky source of finance, as a very small amount of interest is paid on that. But if a company is not able to pay that interest to debenture holders, and company is not able to return the principal amount of debentures, then such debenture holders can file a case against company and can take the company to the liquidation. So it is very risky source of finance from the side of company. Companies have to pay interest. It is very compulsory, otherwise there can be very bad consequences. So it is very risky from the side of company. But if I am talking about from the side of investors, then that is very secure for them, because it is confirmed if they have invested their money in the debentures, or if they have given loan, definitely they will get interest as well as principal amount. So in case of that, from the side of company, it is very risky, and from the side of debenture holders, it is very safe. Now I will talk about equity. Students, equity is most safe source of finance from the side of company, because if in any year there are profits, then only dividend will be distributed among shareholders. But if in any of the year no profits are here, then no dividend will be given to the shareholders, and shareholders cannot file case against company. So from the point of view of company, equity is most safe form of long-term finance. But from the point of view of shareholders, equity is risky source of finance, because if in any of the year there is no profit to the company, company will not give them anything. So it is risky from the point of view of shareholders. So students, I hope this second difference between debt and equity is also clear. I told you here, debt is most risky source of finance from the point of view of company, and most safe from the point of view of investors. Equity is most safe from the point of view of company and very risky from the point of view of investor. Now students, I will discuss with you different factors which a finance manager must consider while taking financing decision. So students, different factors which a finance manager must consider while taking financing decision are: first is cost. Students, cost of different sources of finance are different, and a wise finance manager choose that very source of finance which is cheapest source of finance. So debenture from the point of view of cost is cheapest source of finance, because it is a tax deductible expense. Tax deductible expense means that by issuing debentures, companies gets a benefit in the payment of tax. Second factor is risk. So students, different sources of finance is having different risk. So a finance manager must consider quantum of risk also before selecting a source of finance. So from this point of view, debt is the most risky source of finance. As I discussed with you today, that on the debt companies have to pay interest definitely, and if companies are not able to pay interest, debenture holders can file a case against company. So from the point of view of risk, that is the most risky source of finance, so it should be avoided from this point of view. Next is flotation cost. Flotation cost means cost of raising finance. Like whenever any source of finance is going to be issued by the company, like a company is going to issue shares, there are so many expenses are incurred by the company in making the issue of shares a successful event. Like a company is going to issue shares, then company has to incur advertisement expenditure. Companies have to give advertisement that they are going to issue shares. They have to print prospectus. They have to appoint bankers, auditors, etc., and to whom they have to fee some they have to give some fees also. So a number of expenses are incurred by the companies when they are going to issue any security, shares or debentures, etc. So if there is high flotation cost of a particular source of finance, high flotation cost make the source less attractive. So a finance manager should select that very source of finance which bears less flotation cost. Next is cash flow position. Cash flow position means when a company is having good outflow and inflow of cash. So if a company is having good cash flow position, it means that company is able to make payment of interest and principal amount of loan on time. So that company can go for debt. But if a company is not having good cash flow position, that company should not go for debt. That company should go for equity. Next is level of fixed operating cost. Now students, before explaining this point, I will tell you cost can be of two type. Fixed cost can be of two type, fixed operating cost and fixed financial cost. Fixed operating cost includes like insurance premium, that is if company has taken insurance policy it is mandatory to pay premium. Building rent, salaries of the permanent staff, these are the fixed operating cost which companies have to bear. And fixed financial cost is what? Fixed financial cost is interest on debt. If company has arranged finance through debt, it is compulsory to pay interest on debt. So that interest which company has to pay is called as fixed financial cost. Now I will explain you this point. If a company is having high fixed operating cost, if a company's operating cost is more, that company cannot bear fixed financial cost. So that company should not go for debt. What I am saying, if a company's fixed operating cost is high, that company should not issue debt because that company will not be able to bear the interest. But if a company's fixed operating cost is very low, they are not having an insurance policy or their building is their own, they are not required to pay any rent, it means their fixed operating cost is low, that company can issue debt, means debenture, because that company can bear interest on debenture easily. So I think my point is clear. If a company's fixed operating cost is high, that company should not issue debt. But if a company's fixed operating cost is low, then that company can go for issue of debt. So this is the fifth point, level of fixed operating cost. Now student, one more point is there, that is control. Students, generally the control of company remains in the hands of equity shareholders. Generally, equity shareholders are having control on the company and debenture holders don't interrupt in the control of a company organization. So, if existing shareholders of a company don't want to lose control of the company in many hands, then such company should not issue more equity, because if more equity will be issued, means if more shares will be issued, then more shareholders will enter in the company, and if more shareholders will enter, they will interfere in the controlling activities of the company. So if a company's existing shareholders don't want to lose control in many hands, they should not go for equity. But if they are not having any problem regarding this control, then they can go for equity. वो इक्विटी इशू कर सकते हैं. If they are not having any problem regarding the control of company, they can go for equity. But if they are having problem, they don't want to lose control in many hands, then they should go for debt. They can issue debentures. Now students, last point I will discuss with you, that is state of capital market. there can be different state of capital market. What happen in the market? Different type of situation occurs. Sometimes boom situation occurs and sometimes depression situation occurs. Boom situation means when market is at the peak, when there is high demand, high supply, prices are also very high. And depression period is that period when market is very low. There is no demand for the goods, no supply, and price are also very low. So students, suppose in the market boom period is going on. So at that time market is at the peak and stock market is also rising. At that time people prefer to invest their money in the shares, because at that time market is earning high amount of profit, and if people will invest their money in the shares, they will get big profits in the form of dividend. So at the time of boom period people prefer to invest their money in the shares, so company should issue equity in the market at the time of boom period. But suppose depression period is going on, at that time market is very low and there is no scope of profit. People don't want to invest their money in the shares. They invest their money in the debentures because they know whether there will be profit to the company or losses to the company. Companies have to pay them interest definitely. So they invest their money in the debentures. So at the time of depression period, companies should issue debentures. Clear? So I told you at the time of boom period companies should issue shares because public want to invest their money in shares in boom period, and at the time of depression period companies should issue debentures because at that time people want to invest their money in debentures. So students, here topic factors affecting financing decision is over. I hope all the points are clear to you all. Even then, if you have any doubt, you can discuss with me right now. Thank you, students.